Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, and technology. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Michael Smith, Managing Director, STS Capital Partners, Nicholas Rodriguez, partner at Winston Strawn, and Jim Cassel, co-founder and chairman of Cassel, Salpeter and Company. They join us to discuss what's driving M&A deal activity despite a challenging economic environment and high interest rates. Gentlemen, it's great to have you with us. Welcome to Trade Talks. And Jim, let's kick it off for a moment here. What's the current state of the M&A market? What were some of the factors behind the decline?
I think right now the market is murky. People thought at the beginning of the year, late last year, that interest rates were going to start dropping, that the market was going to start seeing recovery. A bunch of companies started preparing fourth quarter with their bankers, beginning of first quarter, thinking they would go out. A lot of that has been put on hold. So it's not the frothy market that people thought would start, and having seen the first quarter numbers, those numbers reflect that. It was not a great first quarter in most areas.
Yeah. Michael, would you say that some of the frothiness had to come out of the market relative to what we saw in 2021 and 2022? I mean, valuation reset is not that bad of a thing.
Interest rates will do that. So I think clearly we saw that. I think that the strategic acquisition side of the business versus the financial buyers, there's still opportunity in that area that we're seeing. So I would say that anything that's not focused on strictly the financial deal with real accretive value is still in the market doing pretty well. Yeah. So I would separate those two things.
Yeah. And Nicholas, from a global perspective, how does M&A continue to fare in 2023, and then in 2024, what you're seeing now?
Well, what you saw in 2023 was a difficult year. I think towards the end, the fourth quarter of 2023, things were a little bit better and they bounced back. So I think at the beginning of the year, there was some enthusiasm that things were going to get better. I think central banks throughout the world were signaling a rate cut. I think given the economic situation right now, that's taking a back seat, and people are not as optimistic that the rate cuts will happen or will happen as soon as they're expected. But I think what you're seeing on a worldwide basis or on a global basis, because in the first quarter it bore it out, that there was an increase in M&A activity. I think it was approximately a 30% increase in deal value. So we're seeing some positive movements. It's not as crystallized as we would like it to.
Well, take interest rates out of the equation here for a moment, Jim. Where are you seeing areas of improvement? What's driving deal activity?
I think what's happened is people have to do deals in some cases. Private equity firms are getting questioned by some of their limited partners. They want return of capital, so that's causing it. There's the distressed market is more active today than it was. Bankruptcies were up last year, the first quarter they were up. That's driving sales. So there are areas and pockets, and then there's some of the bigger deals, some of the energy deals that got done, or Capital One's acquisition of Discover, whether that gets approved, the antitrust issues we'll talk about later, but those kind of issues. There are opportunities out there, and some deals are getting done.
Yeah, I mean, especially with distressed M&A. To your point, what are some of the more active sectors, Michael?
Well, certainly energy continues to be an active sector out there, and technology and AI is the number one. I mean, I think everyone is looking to understand where they can gain value and competitive advantage from AI today. Most of the deals are still a little premature because it hasn't been proven out, the technology in many cases, but there are bets being made today on that.
Yeah.
And sorry, I think what's driving that as well, the technology part, is companies are always looking for the digital transformation and innovation, and sometimes what happens, it can't be done organically, or it just will take too long of a time. So I think companies are looking for M&A targets to be able to boost that and increase revenues and earnings.
Well, let's talk about that some more. How are companies preparing?
One thing before we go to that, in the distressed area, if you look at biotech and you look at technology, there are a lot of companies that raised money to a point. Their funding partners have decided they're not going to continue funding, and they've got good technology or good biotech, so it's forcing them to go to market maybe before they want to, prematurely. So many companies are having to do that. So that's driving part of the market in the distressed area. Companies are preparing themselves to go to market. They're having to put a story together, the right story together. They might do a quality of earnings and other things, but they're also having to think, is now the time or should I wait? And even private equity funds now have decided, well, we've got to do something. So they're doing their continuation funds as a way to sell. They're really not selling, they're selling to themselves, but they're giving their limited partners a chance to opt, take money off the table, either bring new partners in or continue with the existing partners. So people are having to be creative in this market to get things moving forward. Yeah. It takes creativity.
And I think that's why you're seeing the drive down in multiples from that whole scenario, for sure.
Well, I'm certainly subjective, the buyer and seller valuations, how they perceive it. Does that create somewhat of a stalemate, or is it, I mean, if you don't have any funding, you don't have any funding, you might just have to take the deal. Yeah,
I think that's exactly what it is, and it drove multiples down by as much as 50% in some industries, right?
With those multiples going down, people are doing the things they've done traditionally, which is, some buyer-seller financing, maybe to bridge some of that gap. You also see a lot of private equity funds. There's a deal from one private equity fund to the next private equity fund. Used to be the bigger fund just bought the company and it was theirs. Now you're seeing some of those small funds take a portion, 10, 20%, maybe 30% of their existing ownership and rolling that in to the new vehicle. And that's how they're bridging gap. And frankly, that's also how they're giving confidence to the buyers that there's that next growth cycle. Because if you're buying, you want growth.
And again, I would say, but that's not necessarily a liquidity event. It could be just an equity event that's just swapping equity, which becomes an issue in many cases for certain shareholders.
Right.
By the way, Jill, one of the things that we're talking about bridging the valuation gap, because there is a disconnect, right? And part of what generates that or engenders that is the fact that the financing costs are so high, and the instability of the market. Earnouts. I mean, I feel like every time I'm in a negotiation that when we're talking about the purchase price and the valuation, that is where we usually come to. It's how can we bridge that gap? And usually, one of the suggestions is, in addition to seller financing, it's the earnout.
Right. Let's go back to liquidity versus equity, though. You seem to have a reaction with that.
Well, again, it's a deal. I'm not saying it's not,
right.
But in terms of a middle market player or someone looking for liquidity, it's really not a good option for them, especially if they've had their money tied up for 5, 6, 7 years in some instances, right?
But they're getting some of their money. They're getting a portion. Return of capital, as Will Rogers said, is as important as return on my capital. So they're getting their money off. They're convincing their limiteds that we've now got a shot and we didn't have to leave everything on the table. So it's a little bit here and there. It's absolutely a trade-off.
I would say, just in terms of looking at interest rates and the way they are, one of the interesting markets is like Japan, as an example, where they have 0% interest still in that country. Does provide for good buyers in some instances where you weren't seeing them in the past. And that's something that we're seeing right now in some of our global deals, where the Japanese that have a low rate of interest are able to come in, and there's a strong position for them actually to try to go global as their whole economy is shifting.
But look at the exchange rates with Japan over the last few months. You can have no interest and the exchange rate starts moving back to where it was and they take a loss, not because of anything other than exchange transactions, because the dollar is obviously very strong right now, especially against the yen and other currencies as well.
Right. But at this peak, it'll typically go down at this point, which will help them.
But it's so interesting when you have these things that are unrelated to operations starts to impact, liquidity options in the balance sheet and so forth. I want to go back to active sectors for a moment. You pointed out that the sports industry is a hot spot.
It's a very, last year was a record-breaking year, and it's very small still by other industry compared to other industries. But it's something that people are very, very interested in. Not only investments in sports teams, but investments in sports technology. And then I think it's the opportunity to create so many more leveraging opportunities, marketing opportunities. So it becomes this ecosystem that has been really exciting for lots of individuals.
Yeah. Let's talk about deal execution risk for a moment here. Jim, you had brought up, the antitrust environment and what's happening there.
Today, even on the smaller end of deals, you're seeing antitrust issues where they never would have come up before. Sometimes you're even seeing that after the fact. You're seeing CFIUS, which is, the government looking at smaller deals, healthcare deals. You're selling a drug company and they're looking even smaller deals, which never was the case before. So you have to bake that into certainty to close. If you've got a buyer who's foreign who's willing to pay more, But a buyer who's domestic, who may be willing not to pay quite as much, the certainty to close is always important to a seller, especially in a market that's not so clear.
And what you have to bake into that also is the time to get, even if you are approved, the time to get the approval. That now it could be up to 18 months. In the good old days, I think you would have situations where the deal wasn't completely clean, but the government would come back and say, all right, let's agree on a negotiated settlement, a consent decree, where you can keep 90% of the business, sell the other 10. The government's not even interested in doing that anymore.
Right.
There's just no interest really in negotiation. There were instances where potential deals went to courts, and they did arrive at a negotiated resolution and a consent decree, but they're few and far between. I think.
And how long did that take?
A long time. And so I think that's the concern. And to Jim's point, it's something that you have to factor in from the very, very beginning. It's not something that you think of after the fact. I think it's taken on a lot more time, a lot more energy and resources to really evaluate the antitrust risk. And it's not just in the US, you see it on a global level.
I mean, 18 months is a long time.
Yes.
A lot changes. I mean, think about if you had a deal in place at the end of 2018, beginning of 2019. Well, what happened in March 2020 when the dynamics of everything shifted.
And most deals provide that at that point, once you've signed that definitive agreement, the only thing is approval, not other changes. So business can go up, business can go down. People try to define, what's a material, what's a MAC to get out, and they don't want that to happen. They want to leave it very specific to approval. And people's attitudes today on that approval are different than what they were before because it is a changing climate. And some business can't survive for that 18 months during that, so they opt to do a different type of deal.
Yeah.
Or sell to someone else where they can avoid it. In some cases, you can't avoid it, just merely because of size.
Right. I mean, even look how fast interest rates went up. In 9 months, it's not easy to operate in an environment like that. And then, if you have an 18-month time span, right, for a deal.
Well, think about it. In 18 months, we've had over 525 basis point increase, right, in interest rates. So.
I mean, who would have modeled that in?
Right, into their model, right.
You didn't stress test that.
Right, and if you're waiting for the regulatory approval by that time, you're in big trouble.
Why do
the whole deal structure.
Michael, why do you think we're seeing a heightened level of scrutiny?
I just think the speed of change is so fast today that the risk is different than it was years ago, right? And people are trying to assess those risks today in a different way. What you can put into an agreement is one thing, but people are putting walk-away buyouts in those types of deals if regulatory doesn't come in, if other factors change when you have to wait that long too. So the deal structures are changing to accommodate the speed of change if a deal is not going to close in a typical 9 to 12 months.
So absolutely, you have staggered rates and fees. You have ticking fees now, reverse termination, higher reverse termination fees. So it's you have negotiated agreements as to what you're willing to do or sell or divest of. So you're right. The market has responded, and it causes a lot of uncertainty, and that's why, again, before the deal signed, you're really scrutinizing it and really evaluating to make sure it makes sense.
Mm-hmm. And so when you think about the remainder of 2024, do you think it improves the M&A space?
The M&A space, look, I'm a bit more optimistic. I think what I would say, it's more, you use the word murky. Choppy is a good word. I think it's not this linear recovery. I think there are going to be months where it's going to be very active, and then there are other months where people just pull back. And I think it's again a function of interest rates, which is absolutely impacting valuation, absolutely impacting the ability to raise financing in order to pay for the purchase price. And confidence, right? I think that really sucks the life out of deal makers in corporate boardrooms when they're evaluating all these factors and there's so much risk, and you're telling a buyer, all right, I'm going to pay this amount of money, but does it make sense given the current economic conditions?
So I think there's more technical risk than financial risk today. I think that people understand that rates are probably going to remain where they are, and the decisions are going to be made on a longer term cost of capital, period. I think the technological risk of AI and how it's going to change an industry, I can give you an example, some regulatory risk where you have the trucking industry looking at now in California, 10% of the fleet has to be electric. That changes the whole dynamic of the industry and the buying patterns that'll occur in terms of acquisition. So I think those are the things that people are really getting used to versus the financial risk. I think everyone understands rates are going to be higher, period, moving forward.
And there's the geopolitical risk.
And by the way, we have an election.
We have an election coming up,
exactly.
which we don't want to talk politics.
Right, but an administration change does.
It could,
impact
or
business.
the administration staying in place,
Right.
May change things the way they're going. And a lot of it's not predictable. And what people have predicted hasn't really panned out in many areas. And of course, you've got inflation, which we thought was under control, but with even the employment numbers came out, compensations going up, which makes sense because you hear of the raises. Some went in at the beginning of the year. They're not truly seasonally adjusted out. So that's causing uncertainty. I mean, I'm not convinced this year is going to be anywhere near what I would have told you probably last quarter of last year that 24 would look like. I think we're in for a difficult year. I don't think we're going to see the kind of M&A activity on healthy businesses that we've seen, because in order to do that, you've got to have a real reset in valuation, because you can adjust. I mean, you can pay these interest rates. It's not a problem. All you have to do is reduce the prices. Take them down a turn or two, you can absorb interest rates for an extended period of time.
Except for the larger companies that are making a lot of money that can buy for cash.
All cash.
Right. Those are the guys that are going to continue, I think, to make give the best opportunity for deals in the future. And they're buying lots of different types of companies. So.
Or public companies with stock, using stock as currency, right? That's another opportunity. And we've seen a lot of large deals that have been solely stock deals. So that's another opportunity. But look, I think that when you think about what will really inject or increase M&A in 2024, from my perspective, is PE and what PE decides to do. And again, it hinges on valuation and whether we'll be able to bridge that gap. But when you think about $2 trillion, an enormous amount of money sitting on the sidelines, it has to be at some point deployed.
Yeah, but that money's committed. It's not sitting there, it's available. And a lot of the funders of that, the limited partners, they want to see some return as well, because when they made those commitments, it was based on you're going to hold companies for a certain point of time.
Right.
And today, PE companies average, I think, is now over 6 years, the hold period. So they can call that capital, but they have to be sensitive to the partners and what they want to do. But when money's sitting, there's a lot of money in bank accounts right now, real cash, green stuff, and getting 5% or more, so, and wants to deploy it.
Gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.